Hello and welcome to Energy Insights. Today we have to look into the latest development in the energy market, particularly the United Arab Emirates exit from the oil exporting countries organization OPEC. So it's a strategic shock to the global oil markets. We will review and analyze this development in the context of the Iran conflict, Hormuz disruptions, and the emerging energy realignment in the region and as well as globally. So we will cover this in our main segment today, and thereafter we will have a snapshot of the market analysis as of today. So let's dive into the main segment. That's in the UAE exit context. So the global oil market is entering one of its most critical and uncertain phases in recent decades following the United Arab Emirates decision to exit OPEC and escalating the geopolitical tension in the Middle East and continued disruption in the Strait of Hormuz. The timing of the UAE withdrawal is particularly significant as the world currently consumes around approximately 104 to 105 million barrels of oil per day, while the global oil supply also remains near a similar levels. Simultaneously, tensions involving Iran, the United States, and the other regional players are threatening regional supply stability and increasing uncertainty across the international energy markets. The UAE withdrawal from OPEC is not merely an institutional development within the producer alliance, rather it's represents a broader strategic and the geopolitical realignment with the potentially far-reaching implications for the oil pricing, producer coordination, Gulf politics, and the global energy security. As one of the OPEC's largest and financially strongest producers, the UAE has historically played an important role in maintaining market balance and supporting OPEC's collective influence over the global oil markets. Here we have to overview a little background. The global oil market currently operates at historically high consumption levels with the worldwide demand estimated as mentioned earlier approximately 104 to 105 million barrels. Demand growth continues to be driven primarily by transportation fuels, petrochemical industries, aviation, industrial consumption, and energy requirements in emerging economies. China, the United States, India, Europe, and the Southeast Asia remain the largest consuming regions and collectively account for a substantial portion of the global oil demand growth. On the supply side, the global production also stands near 104 to 105 million barrels. The United States remains the world's largest producer with approximately 22 to 23 million barrels per day, including the liquids production, followed by Saudi Arabia with approximately 10 to 11 million barrels per day production, and Russia with around 9 to 10 million barrels per day. Canada, Iraq, Iran, and UAE also contribute significantly to the global supply. Within this broader structure, OPEC collectively supplies approximately 27 to 30 million barrels per day, representing nearly 28 to 30% of the total global oil production. Despite the producing less than one-third of the global supply, OPEC has historically exercised substantial influence over the international oil prices because of its concentration of the low-cost reserves, spare production capacity, and coordinated production management policies. The organization has traditionally served as the primary mechanism for balancing markets during the supply disruption and periods of price volatility. Now, the UAE's strategic importance within the OPEC context. Although UAE contributes approximately 3.5 to 4.5 million barrels per day, which is equivalent to nearly 4% of the global oil supply, the strategic importance extends far beyond production volume alone. The UAE has historically been one of the OPEC's most influential Gulf producers due to its low production costs, strong financial positions, modern upstream infrastructure, export flexibility, and the geographic proximity to the major Asian energy markets. Over recent years, Abu Dhabi has invested heavily in the upstream expansion projects and has targeted future production capacity of approximately 5 million barrels per day. However, OPEC production quotas increasingly constrain the UAE ability to fully utilize this growing production's infrastructure. As a result, the UAE appears to have gradually shifted toward prioritizing production flexibility, market share expansion, and independent strategic positioning over continued participation in quota-based production coordination. The country is also increasingly repositioning itself as a broader global energy and investment hub with expanding interest in LNG, hydrogen, renewable energy, international infrastructure, and the global energy trading. This diversification strategy aligns more closely with an independent energy policy than with a traditional cartel-based coordination mechanism. Now, what are the strategic drivers behind the UAE exit? The UAE withdrawal from OPEC appears to be driven by the combination of economic, strategic, and the geopolitical considerations. And one of the primary drivers is the country's ambition to expand oil production capacity and maximize export revenues. OPEC quotas increasingly limited Abu Dhabi's the UAE ability to increase output, expand market share, and optimize returns on long-term infrastructure investments. At the same time, policy differences between Abu Dhabi and some other regional players reportedly widened regarding production discipline, pricing strategies, market share management, and long-term supply policies. While other regional players continued emphasizing coordinated production cuts and supply management to stabilize oil prices, the UAE increasingly favored greater operational flexibility and independent market positioning. The UAE broader economic diversification strategy also contributes to this shift as the country expands its role in LNG, renewable energy, hydrogen, and the global investment market. Strategic prioritize increasingly differ from the traditional objectives of OPEC collective supply management system. And furthermore, the recent developments also had put fiscal pressure, financial pressure on the UAE, and therefore they are looking for the alternates to recover all the hits it received. What are the implications for OPEC of this exit? The UAE departure significantly weakens OPEC internal cohesion and market credibility. Historically, OPEC effectiveness depended heavily on the coordinated production discipline, internal political alignment, collective spare capacity management, unified market intervention strategies. The withdrawal of one of OPEC's largest Gulf producers raises concerns regarding the future compliance among remaining members and organization long-term ability to influence the global oil prices effectively. More importantly, the development signals a broader structure shift in which the national economic priorities are increasingly overriding collective cartel objectives. If additional producers begin pursuing independent production strategies similarly to UAE, OPEC's ability to coordinate global supply management may gradually decline. The risk of competitive production behavior could also increase over time. Producers seeking to protect or expand market share may prioritize higher production volumes rather than coordinated supply discipline, potentially increasing market volatility and reducing OPEC's future pricing power. What are the regional conflict and Strait of Hormuz crisis impact on this decision? The geopolitical environment surrounding the UAE withdrawal significantly amplifies its impact on the global energy markets. The ongoing tensions in the region has intensified instability across the Gulf region, particularly around the Strait of Hormuz, which remains one of the world's most strategically important energy choke points. Almost 20% of the global oil trade passes through the Strait of Hormuz, along with substantial LNG exports from the Gulf producers, destined for the Asian and the European markets. Any disruption in this corridor immediately affects global crude prices, LNG transportation, freight markets, tanker insurances costs, and broader energy security. Recent developments indicate increased naval deployment, shipping delays, heightened maritime security risks, restriction affecting other regional exports, and rising insurance premiums for tanker operations. Although Gulf producer maintains some spare production capacity, logistic disruption and security concerns continue limiting efficient supply flows through the region. What would be the oil market reaction to this decision? The global oil markets are currently balancing two major opposition forces. In the short term, geopolitical tensions, Hormuz, shipping disruption, tight physical supply conditions, falling inventories, and elevated market risk premiums continue supporting higher oil prices. These conditions are creating upward pressure across crude markets despite broader economic uncertainty. However, the UAE independent production strategy introduces long-term structural risks for market balance. Increased non-coordinated supply growth, greater market share competition, weakening OPEC discipline, and potential future oversupply risk may contribute to higher market volatility over time. Consequently, oil markets may increasingly experience alternating cycles of geopolitical price spikes and oversupply driven corrections. Although the UAE contributes only around 4% of the global supply, its ability to rapidly increase production during market disruptions gives it a strategic importance well beyond its numerical production share. Its withdrawal therefore represents both symbolic and operational loss for OPEC. Now, what are the global energy security implications in this context? The simultaneous emergence of OPEC fragmentation, Middle East instability, and the Hormuz disruption is expected to reshape the global energy security strategies. Import-dependent economies, particularly in Asia, are likely to accelerate investment in LNG diversification, strategic petroleum reserves, renewable energy deployment, alternate supply routes, and long-term LNG procurement agreements. The crisis also reinforces the importance of resilient energy infrastructure, including LNG terminals, floating storage facilities, virtual pipeline models, and diversified shipping corridors. Government and energy companies are expected to increasingly prioritize supply security and logistic resilience and rising the geopolitical uncertainty. What are the strategic outlook and conclusion? The UAE exit from the OPEC amid escalating Middle East tension represents a historic turning point for the global energy markets. The world currently consumes approximately around 104 to 105 million barrels of oil, while the OPEC supplies almost 27 to 30 million barrels. Within this structure, UAE contributes around 4%, and its target expansion towards 5 million barrels make it one of the most strategically important producers in the Gulf region. In short term, geopolitical instability and supply disruptions are sustaining elevated prices and increasing uncertainty across crude and LNG markets. However, the longer term implications may prove even more significant. The weakening of OPEC cohesion threatens to fundamentally alter the structure of the global oil markets governance, potentially shifting the market toward a greater fragmentation, independent production strategies, reduced cartel influence, increased price volatility, and intensified the geopolitical competition. At the same time, continued instability around the Strait of Hormuz reinforces the urgent importance of the energy diversification and resilient supply infrastructure for importing nations worldwide. The coming months will likely determine whether OPEC can preserve its strategic relevance or whether the global energy system is entering a fundamentally new era of geopolitical structure realignment. So this concludes our main segment of today's episode. Now we have to look into the global energy market snapshot to overview the latest updates from the market. Global energy markets today show a mixed performance across the crude benchmarks, with clear divergence between the seaborne, inland, and the Gulf linked pricing signals compared to the previous session. Brent crude is trading at $111.60 per barrel, reflecting a 0.34 US dollar increase, which is almost 0.31% increase from the previous day. The upward movement is primarily supported by sustained geopolitical risk premiums, particularly linked to the Middle East instability and concerns over potential disruption in supply flow through the Strait of Hormuz. WTI crude is trading at $99.70 per barrel, showing a negative downside moment of 0.23% decline. Compared to yesterday, the slight weakness reflects relatively stable US supply condition and persistent structure discounting due to the inland logistic and export constraints. Murban crude, the key UAE benchmark, is trading $106.70, which showed an upward momentum at 2.4% increase as of yesterday. In the case of OPEC Basket, it traded $107.62 per barrel, showing a downside decline of 0.66% from the previous day. This mild softness contrasts with the strength in the Brent and the Murban, suggesting increasing divergence within the OPEC linked pricing and weakening internal alignment. In natural gas market, Henry Hub is trading at $2.67 per MMBTU, reflecting a negative momentum of 0.67% decline, indicating stable US supply conditions with limited demand driven movement. The Europe TTF benchmark traded at $15.38 per MMBTU, showing a marginal decrease of 0.23%, while the Asian LNG JKM remains stable at $16.56 per MMBTU, with no meaningful change from the previous day. Overall, compared to yesterday, the market reflects a firming trend in Brent and Murban crude, slight weakness in WTI and the OPEC basket, and broadly stable LNG pricing across the major hubs. The divergence highlights increasing fragmentation in the global energy pricing, with the Gulf benchmarks showing strongest momentum, while the coordinated OPEC pricing slightly appears comparatively weaker. This concludes our today's analysis. Thanks for watching.